Hi, I am Santosh Kamath. I am the CIO for the fixed income business for Franklin Templeton Mutual Funds in India. The idea of this presentation was to give a broad overview on the macroeconomic scenario in the country and to finish with the challenges in going forward and the opportunities that will come up for investors in the fixed income space. The first key macroeconomic variable on the GDP growth, we are seeing consistently slowdown in the GDP. Now, a typical response for a slowing GDP is interest rate cuts, monetary easing, which will help the GDP grow over a period of time. Unfortunately for India, while the GDP growth is kind of coming down, you have concerns on inflation and current account deficit, which are kind of moving up. This is a slightly strange scenario because typically when you see macroeconomy slowing down, GDP slowing down, when expectations are that your inflation and current account will also come down over a period of time. Unfortunately for Indian context, that doesn't seem to be working that way. So while you on the slowing GDP growth, you want RBI to cut rates, while a higher current account deficit, a higher inflation would want some kind of tightening on the policy. The new trend we are seeing is the FII investors coming in the fixed income space. You may actually recall that on the equity side, early 1990s, we actually opened up our equity space for FII investors, and over the last 20-25 years, we have seen a decent amount of FII flow on the equity side. On the fixed income side, on the last couple of years, we opened up the space for fixed income investors. To begin with, we had different quotas. We had quotas for infrastructure bond, we had quotas for long-term fixed income space. Lately, we have seen that all those kind of quotas have been kind of removed. Now we have kind of very flexible on where the investors can come in on the fixed income space. One of the key factors one of the key reasons why we see FIIs kind of allowed in the fixed income space is because of the large current account deficit we have in India. Just to put some numbers in perspective, this year probably will close with a current account deficit of $100 billion. And in a very layman term, we need this $100 billion to be coming in the form of FDI or FII equity or FII debt, so that the difference between exports and import can be bridged. So what's going to happen going forward? If the market gives more weightage to the slowing economy, the market will tend to believe that the Reserve Bank of India will be more proactive in cutting rates, more monetary easing will happen, and that will take interest rates down. At the same point of time, if the market starts giving more importance to the high inflation, the CPI inflation continues to be close to 10%, the current account deficit is close to 5%, so market tends to give more weightage there, then the market would not expect RBI to take very kind of benign view, and that the rates can actually start going up. So in the short to medium term, please be prepared for a slightly more volatile market. Interest rates will come down, it can go up sharply. Now for fund managers like us, while there is a challenge because of these two different views, it also provides a good opportunity to participate in the fixed income space that can benefit our investors. Now in this kind of scenario, what should investors do? If you ask our view, on a very broad framework, we believe that over a period of time, inflation will also come down, current account deficit will also improve over a period of time, and therefore very broad call is that you can actually be bullish on the Indian fixed income space. If you look at our strategy which we follow in the fixed income space, we have different kind of funds in our mutual fund space, and all these funds will require slightly different strategy in the medium to long run. Let me take you through some broad strategies which we'll follow. So we have these corporate bond funds called the short-term income plan, the income opportunities fund, and the corporate bond fund. Typically these funds don't take too much of interest rate risk. Typically these funds will not kind of trade on interest rate view. But the strategy in this kind of fund is to kind of lend to good companies which can give us a higher yield in the portfolio, stay put for some time. If we get opportunity to generate alpha by kind of selling it to a different market participants and book some capital gains, that's fine. But the broad strategy is to kind of buy and hold these papers for a long period of time, earn the higher coupon, and wait for the spreads to come down to earn the capital gains. The strategy which we follow on the government bond side will be slightly different. This more tactical. We can move maturities very fast depending on what we expect RBI to do, the open market operations which RBI can come up with, the inflation numbers which keeps coming up on a frequent basis. All those kind of determine what we do or how we approach the government bond. The income funds, which lie somewhere in between. So while there's three different strategies for three different asset class, but what does it mean for the investors? For the investors, what it means is that the more actively managed GSEC fund will be more volatile in nature, and the more passively managed corporate bond will be that much less volatile on the return side also. And the income fund, as I said, is somewhere in between these two categories. We also have a space which is the money market space, the liquid funds, the ultra short-term bond funds. Those are typically managed with a very short-term maturity, so those will be least volatile. That is typically buy and hold on a very shorter end basis. But with the interest rates keeps coming down, those funds will obviously have low and low coupon. So that will obviously generate lower returns over a period of time. But they are very useful for investors who have a very short-term horizon. They need to invest for a week or 10 days. Those kind of funds will be the best funds to invest for those kind of investors. Going forward, a sharp deterioration in the current account deficit will warrant a very different response, and there should be, as a market participants, will be very careful or cautious on that front. At the same point of time, if we see a current account coming down, inflation coming down, we will turn much more bullish than what we are now. So maybe next couple of months clarity will emerge, but till that time I think if you're overweight on the corporate bond and opportunistically take position on the government bond side, that looks to be a good strategy to follow.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.